If companies have excess cash, they may find it beneficial to invest that money and make a better return. And they can do that by buying stock of another company. They call those equity securities, or they can lend to a company by buying bonds. So they refer to these as marketable securities. Now there's different types of securities. We're going to just deal with what's called trading securities. In other words, the company's just buying them for the short term and will plan on selling them in the near future. What's beyond the scope of our course is these things, or these types of securities that are called available for sale or held to maturity. That's for intermediate accounting. So anyways, let's assume we're a stock Bell and that we have 10,000 to invest, and so we buy stock of another company. Now, we're not going to buy bonds, we're going to buy stock, and I'm going to show you how you record that investment. So what the company is going to get is marketable securities. Sometimes they'll call it short-term investments, but we'll refer to them as marketable securities. So you get an asset and then you give up cash. And by investing in that, you hope to have income from dividends. That's the distribution of profits, but this time we're on the receiving end, unlike these other modules where we're issuing stock and having to pay the dividend. So the situation here is that this company has the dividend of $100, and then the other thing is you hope that the price will go up. So here we are in number 2, where we have received a $100 dividend. You got cash, and what we have is a revenue account called dividend income. So you basically have provided a service in a sense and letting them have your money. Now, as far as at year end, an unusual situation is that GAAP allow marketable securities. Unlike any of your other assets, this type of asset, if it's a trading security, can be revalued to its fair value at year end. So land you can't. Land you must leave at cost because it's too subjective as to what the value is. But marketable securities are marketable, meaning they are being traded on a stock exchange or bond exchange. So at the end of the year, Stocko's year end, we'll say, is December 31, they can see exactly what those shares were selling for. So there were actual shares traded. Well, let's say with this example that at year end they found that the shares of stocks they have are worth 10,200. The cost, or what they paid, was only 10,000. So what you can do, and then this is an exception to the cost principle, is they can revalue the marketable securities. So we'd increase this to 10,200. Now you can't just go putting balances on in accounts. You have to make an entry. So to get the 10,200, you'd have to debit marketable securities. Now you're not actually selling these, but the reason you are increasing them is because you've had a gain. Now they call this a gain. It's a shareholders equity account because it does increase the wealth of the company, and it will be a credit to, and they call it not plain gain or gain, they call it unrealized gain because it's in a sense a paper gain. They haven't actually sold the stock yet, but if had they sold it on December 31, they would have gained 200. So unrealized is meaning that it hasn't been locked in, but it does mean shareholders equity has grown. As far as financial statements, when you record these on the financial statements, you have your dividend income and the gain on your income statement. And then as far as cash flows, we have the receipt of dividends. In other words, I'm taking the 100 here and the 10,000 there. So if you look at it, the receipt of dividends is an operating activity, unlike paying dividends, which is a financing activity. And then the purchase goes under investing activities. So marketable securities is an investing activity, which again, investing activities is cash in or out related to long-term assets and marketable securities. Now I just want to go through, what if the amount of the investment at year end was 10,000 or 9,800 rather than the 10,200, well, in that case, you're going to actually have a loss. So I'm going to try to get that on the screen here. Sorry. Here we have this ending balance would have to be 9,800. So you'd have to credit short-term investments for this loss in value, and you would debit a shareholder's equity account, and it'd be called unrealized loss in this case because it reduces shareholders' equity because the value of this investment, which is really marketable securities, sometimes called short-term investments. We'll call them marketable securities in this class. So again, you record the income, and then at year end you revalue the securities to their fair values, and the difference will either be a gain or a loss called unrealized gain or unrealized loss. Later, when you sell the securities, it would be called a regular gain or loss depending on how much you get for the securities when you actually sell them.